I bring you greetings. We look at identifying and assessing risk. We will look at risk and risk management, categories of risk, concepts in risk management, identification, assessment, and measurement of risk, and perhaps the chapter review. The aim of this module is to enable students to understand and apply tools and models to develop skills in strategic analysis, choice, and implementation. You will also become competent in the use of management information to measure and monitor strategic performance. A comprehensive review will be undertaken of good governance practice, all developed within applicable ethical frameworks. Evaluating complex scenarios will be a feature of this module, based on complex data, financial and stakeholder analysis, including making recommendations. We will also be expected to apply concepts, principles, and theories from the knowledge and application levels in there. The details may include explain and analyze the arrangements required and prepare business plans for a specific scenario for an efficient and effective implementation of an organization's strategy. Prepare business plans to implement a chosen strategy, paying attention to developing a business risk management approach involving identification of risk, assessing risk impact, and management and mitigation of risk. In exams contest, all organizations face risk in some format. The challenge for management is to make decisions regarding risk that are acceptable to the stakeholders. This is the first of two chapters that address risk in organizations. In this module, you will focus on identifying and assessing risk and control in the next series. At the end of this series, we will be able to discuss the nature of risk, risk management, and risk responsibilities, explain and demonstrate the different categories of risk, summarize risk management concepts, including exposure, risk appetite, and risk-based approach. Identify, access, measure, and prioritize risk with consideration of the impact of risk on stakeholders. Risk and risk management. We look at the nature of risk, the nature of risk management, responsibilities for risk management, then elements of a risk management system. The nature of risk. Risk is usually associated with the possibility that things may or might go wrong, that events might turn out worse than expected, or that something bad might happen. However, risk has a broader meaning. Risk exists whenever a future outcome or future event cannot be predicted with certainty, and a range of different possible outcomes or events might occur. Risk can be divided into two categories. We have pure risk and speculative risk. We look at pure risk or downside risk. Have you heard it before? Do subscribe so we learn more. Pure risks, also known as downside risk, are risks where there are possibility that an event which is adverse might occur. Events might turn out to be worse than expected, but they cannot be better than expected. For example, there might be a safety risk that employees could be injured by an item of machinery. This is a pure risk because the expectation is that no one will be injured, but a possibility does exist. Similarly, there might be a risk for a company that key workers will go on strike, and the company will be unable to provide its goods or services to customers. This is a pure risk because the expected outcome is no strike, but the possibility of a strike does exist. We also move on to speculative risk or two-way risk. Speculative risk, also called two-way risk, exists when the actual future event or outcome might be either better or worse than expected. 1. For instance, an investor in shares is exposed to a speculative risk because the market price of the shares might go up or down. The investor will gain if prices go up and suffer loss if prices go down. And a second example is an individual might ask his bank for a loan to buy a house, and the bank might offer him a 10-year loan at a fixed rate of interest or at a rate of interest that varies with changes in the official bank rate. The individual takes a risk with his choice of loan. If he chooses a fixed interest loan, there is a risk that interest rates will go up in the next 10 years, in which case he will benefit from the fixed rate of his loan. On the other hand, interest rates might go down and he might find that he is accommodating more in interest than he would have done if he had arranged a loan at a variable rate of interest. The third instance with speculative risk or two-way risk can be seen in this way. Companies face two-way risk whenever they make business investment decisions. For example, a company might invest in the development of a new product on the basis of sales and profit forecasts. Actual sales and profits might turn out to be higher or lower than forecast, and the investment might provide a higher return, moderate return, or low return, or even a loss. Companies face both pure risk and speculative risk. Pure risk are risks that can often be controlled either by means of internal controls or by insurance. These risks might be called internal control risk or operational risk. On the other hand, speculative risk cannot be avoided because risk must be taken in order to make profits. As a general rule, higher risks should be justified by the expectation of higher profits, although events might turn out worse than expected. The company needs to decide what level of speculative risk are acceptable. Speculative risks are usually called business risk and might also be called strategic risk or enterprise risk. Business decisions taken by management could involve both business risk, herein strategic risk, and operational risk, that's downside risk. An example of strategic and operational risk. The following examples illustrate how there are both strategic risk and operational risk in many decisions taken by management. The examples relate to a large public company. Look at the management decision, then comment on the risk. The company has commissioned a software company to design a new information system. The system will be used for marketing analytics and to sell goods to customers online. The comment on the risk. There are strategic risks with the new system. These include the risk that customers will not want to buy goods online and the risk that a competitor will develop a more popular e-commerce website. There are also operational risks. These include risk that the new system will fail to function properly and might suffer from hardware or software faults. These risks can be managed by operational controls. On the other hand, we have a scenario where the company has a large customer service center where its employees take telephone calls from customers and deal with customer complaints. On average, staff are on the telephone talking to customers about 75% of their working time. Management has decided that in order to increase profits, staff levels should be reduced by 10% at the center. It is stated that this will have only a small effect on average answering times for customer calls. The comment on the risk. There is a strategic risk. The company might lose some customers if the level of service from the service center deteriorates. Management must judge whether the risk of losing customers is justified by the expected reduction in operating costs. There are also operational risks. If employees have to spend more time on the telephone, the risk of making mistakes or providing an unsatisfactory service is likely to increase. There might also be a risk that answering times will be much longer than expected due to operational inefficiencies. The nature of risk management. Risk management is the process of managing both downside risk and business risk. It can be defined as the culture, structures, and processes that are focused on achieving possible opportunities, yet at the same time control unwanted results. This definition identifies a connection between risk and returns. 1. The safest strategy is to take no risk at all. However, this is an unrealistic business strategy. All business activity involves some risk. 2. Business decisions should be directed towards achieving the objectives of the company. The main objective is usually to increase value for shareholders over the long term. 3. Strategies are devised for achieving this objective, and performance targets are set. The strategies should be consistent with the amount of business risk that the company is willing to take, and the targets should be realistic for the chosen strategies. 4. The strategies are implemented, and management should try to achieve the stated objectives and performance targets, but at the same time should manage the downside risk and try to limit the business risk. A link between management of operational risk and management of strategic risk can be seen in the following statement from a bank. A priority for us is to maintain a strong control framework. This is the key for delivering effective risk management. We have further strengthened risk analysis and reporting so that risk and opportunities are identified, and have put time scales and straightforward responsibilities in place at both group and decision level for risk mitigation strategies. Routine management information reporting still has risk at the heart, and balanced scorecards are used to ensure this is in the staff objectives. Responsibilities for risk management. Risk management is a corporate governance issue. The board of directors have a responsibility to safeguard the assets of the company and to protect the investment of the shareholders from loss of value. The board should therefore keep strategic risk within limits that shareholders would expect, and to avoid or control operational risk. The Cadbury Report of 1992 described risk management as the process by which executive management under board supervision identifies the risks arising from business and establishes the priorities for control and particular objectives. The Ghana Code of Best Practices for Corporate Governance states that the duties of the board shall include, among others, the identification of risk and the implementation of systems to manage the risk. The board is generally responsible for defining the company's risk policy, risk appetite, and risk limits, as well as ensuring that these are integrated into the day-to-day operations of the company's business. This may be achieved by the creation of a risk management committee, discussed further in later sessions. Elements of a risk management system. The elements of a risk management system should be similar to the elements of an internal control system. 1. There should be a culture of risk awareness within the company. Managers and employees should understand the risk appetite of the company and that excessive risks are not justified in the search for higher profits. 2. There should be a system and processes for identifying, assessing, and measuring risk. When risks have been measured, they can be prioritized, and measures for controlling or containing the risk can be made. 3. There should be an efficient system of communicating information about risk and risk management to managers and the board of directors. Also, strategies and risks should be monitored to ensure that strategic objectives are being achieved within acceptable levels of risk. Organizing for risk management. The responsibilities for risk management and the management structures to go with it vary between organizations. Some companies employ risk management specialists, and in financial services, there is a regulatory requirement in many countries for banks and other financial service organizations to have well-structured risk management systems. It is useful to be aware of differences in organization structures and responsibilities. The board of directors of large public companies may be expected to review the risk management system within their company on a regular basis and to report to shareholders that the system remains effective. If there are material weaknesses in the risk management system, a company may be required to provide information to shareholders. For example, the Ghana Code of Best Practices for Corporate Governance states that the Board of Directors may establish a risk management committee to review the adequacy and effectiveness of risk management and controls at least annually, and the board has responsibility to report on the effectiveness of the controls to shareholders. A company may decide that it needs a senior management committee to monitor risk. This management committee may be chaired by the CEO and consist of the other executive directors and some other senior managers. It may also include professional risk managers or the senior internal auditor. The function of this executive committee would be to coordinate risk management throughout the organization. 1. It will be responsible for identifying and assessing risk and reporting to the board. It may also formulate possible business risk management strategies for recommendation to the board. It also should agree on programs for the design and implementation of internal controls. Furthermore, it should monitor the effectiveness of risk management throughout the company, both business risk management and the control of internal control risk. Risk management should therefore occur at both board with the involvement of independent non-executive directors and operational level with the involvement of senior executives and risk managers. A risk management committee of executives should be a source of information and advice or recommendation for the board. Categories of risk. In this, we look at the need to categorize business strategic risks, categories of risk common to many types of business, nature and importance of business and financial risk. And we also look at business risk in different business sectors. The need to categorize business or strategic risk. A risk management system might be based on a categorization of risk. There are no standard risk classifications because the nature of business risk varies between different types of business. The reason for categorizing risk is to give some structure to the risk management process. In many large companies, risk committees are established, and each committee is responsible for identifying, assessing, and measuring business risk in a particular category. The risk committee then provides information on risks to managers in a position of responsibility for taking decisions to control the risk, for example, by introducing new risk control measures. The board of directors might use the same risk categories to provide their reports on internal control and risk management, or to discuss risk in their annual business review. That's narrative report. Categories of risk common to many types of businesses. Some types of business risk are common to many different industries. The 10 Bull report mentioned the following risks that may be significant. We have market risk, credit risk, liquidity risk, technological risk, legal risk, health, safety and environmental risk, reputation risk, business probity risk. Each of these risks is explained below with examples. The examples consist of cases where events turned out badly for companies. It is important to remember, however, that risk management is not concerned about adverse events that have happened in the past. It's about managing risks that exist now that could affect events and profits in the future. Market risk. Market risk is the risk from changes in the market price of key items, such as the price of key commodities. Market prices can go up or down, and a company can benefit from a fall in raw material prices or incur a loss from a rise in prices. A company might be able to pass on higher prices of raw materials to the customer by raising the prices for its own goods or services. However, if it puts prices up, there might be a fall in total demand from customers. Higher prices leading to falling sales volume could result in lower profits or losses. Example of market risk. An oil company described one of its major risks as the risk of rising and falling oil and chemical prices due to factors such as conflicts, political instability, and natural disasters. The term market risk can be applied to any market and the risk of unfavorable price movements. A quoted company may therefore use the term market risk when referring to the risk that its share price may fall. Similarly, a bank includes the risk of movements in interest rates and foreign exchange rates within a broad definition of market risk. We move on to credit risk. Credit risk is the risk of losses from bad debts or delays by customers in the settlement of their debts. All companies that give credit to customers are exposed to credit risk. The size of the credit risk depends on the size and amount of receivables owed to the company and the credit quality of the customers. Credit risk is a major risk for commercial banks because lending is a major part of their business operations. Another risk is liquidity risk. It is the risk that the company will be unable to make payments to settle liabilities when payment is due. It can occur when a company has no money in the bank or is unable to borrow more money quickly and has no assets that it can sell quickly in the market to obtain cash. Companies can be profitable but still at risk from a liquidity shortage. An instance is where long-term capital management was a hedge fund set up in 1994 by a group of traders and academics. It was funded by many large investment banks. The company ran into difficulties in 1998 when they found that it was unable to sell securities that it had held in some small financial markets because there was insufficient demand from investors. This led to a liquidity shortage. As the hedge fund became desperate to obtain cash, it had to sell its assets at whatever price it could obtain, and market prices fell. The fall in market prices resulted in big losses, and the long-term capital management was on the verge of collapse. Fearing that the U.S. banking system would suffer severe damage if the long-term capital management did collapse, the U.S. Federal Reserve Bank organized a $3.5 billion rescue package. This major crisis happened because of the liquidity risk and market risk that the hedge fund faced and was unable to manage successfully. Technological risk is a situation that could arise from changes in technology or inadequacy of technological systems in use. When a major technological change occurs, companies might have to make a decision about whether or not to adopt the new technology. If they adopt the new technology too soon, they might incur higher costs than if they waited until later. On the other hand, if they delay adopting the new technology, there is the risk that a competitor will take advantage and use the technology to gain market share. For instance, there are various examples of technological risk. The development of the internet, for example, created a risk for many companies. Traditional banks were faced with the risk that if they did not develop online banking at a high cost, non-bank companies might enter the market and take customers away from them. The internet has also created risks for many retailing companies, which have had to decide whether to sell their goods on the internet, and if so, whether to shut down their traditional retail outlets. The technological risk currently facing manufacturers of televisions and media companies is which kind or which format of high definition, that's HD television, they should support. There are two competing formats, and only one seems likely to succeed in the longer term. Legal risk, which includes regulatory risk, is the risk of losses arising from failure to comply with laws and regulations, and also the risk of losses from legal actions and lawsuits. For example, an example in 2006 was the decision by the US government to enforce laws against online gambling. US customers were the main customers for online gambling companies based in other countries. As a result of the legal action, the online gambling companies lost a large proportion of their customer base and their profits, and share prices fell sharply.